Welcome to Close of Business. I'm Alicia Barry. The world's richest man is now set to become the planet's first trillionaire. Shareholders overwhelmingly approved Elon Musk's plans for robot armies and driverless taxis, which, if achieved, will reward him with hundreds of millions of Tesla shares. But opponents say the right-wing activist has trashed his own brand, and there are doubts over whether he can deliver. Here's David Taylor.
Those bots are just dancing. There are no wires.
From dancing robots to automated doctors.
Optimus will ultimately be better than the best human surgeon.
At a shareholder meeting in Austin, Texas, investors voted in favour of a $1.5 trillion pay packet.
Approved.
If the Tesla founder meets his goals. It's enough money to spend roughly $1 million every day for at least the next 4,000 years. But there's plenty to get done before his ship comes in.
Musk has to deliver 20 million vehicles to customers, build 1 million robots, scale a robo-taxi service to 1 million cars.
Elon Musk's plans for Tesla ramp up next year, with rollouts of the Optimus humanoid robots, Tesla Semi, and the driverless taxi, the Cybercab, to begin production, Elon Musk says, early next year. The billionaire has evolved into a controversial global figure, and his drama-filled flirtation in US politics saw Tesla's share price dive. But now, it seems, Elon Musk has won his investor base back.
And we stand with you.
But support for Elon Musk is not universal. Some fund managers are not convinced that Tesla can deliver enough bang for their buck.
Driven by concerns over the Elon Musk 1 trillion pay package, driven by just the general EV demand, and also driven by how innovative and the project delivery on, robotaxi and XAI. So that has weighed on its earnings futures, which make us to not include it in our growth strategy as well.
Elon Musk finished his highly anticipated investor presentation with a thanks, a bow and a wave, promising to drive one of the world's biggest tech firms into the future.
A pullback on Wall Street caused a reasonable sell-off on the local market at the end of the week. By Friday, the ASX 200 was down 1.3% and the All Ords had lost 1.6%. Julia Lee, head of client coverage at FTSE Russell, joined me. Julia, chants of Elon erupted in the room at the news of the $1 trillion pay deal for Elon Musk. This is the largest corporate payout in history if achieved, but the company already has a price-to-earnings ratio of 306. There is a lot of expectation baked into the share price, and now Elon's carrying it.
Alicia, it was a pretty dramatic meeting with Elon bouncing onto stage with dancing robots. And it's a massive payment, $1 trillion worth of stock, which would represent around about 12% of the company. Now, it is based around operational as well as valuation milestones. And it'll see Tesla turn into an AI, artificial intelligence, and humanoid robot type of business. So what can investors and people at home expect? Well, things like driverless cars. In the US, a robo-taxi network looks like it's on the cards, as well as humanoid robots in the home. But huge expectations there, and if you can pull it off, the biggest pay rise in history.
Well, at the same time, nerves are growing about tech stock valuations. There's been a bit of a pullback on Wall Street this week. Should investors be worried?
If we have a look at the US stock market, it's been performing exceptionally well. October saw another rise, and that was the 6th consecutive month of gains. That means valuations for the US stock market are historically high and very much driven by what's happening in the artificial intelligence as well as technology space. So technology is super important, and in the month of November, we've seen technology getting a bit of the wobbles. Today on the Australian market, we've seen block CDIs down 14%, And that's after the US session came out with third quarter earnings that missed market expectations. So technology is very important to the market rally. So are some of the uncertainties out there. We're now in the 37th day of US government shutdown, and we know that impacts on services as well as data. And in terms of data, private market jobs reports are showing that the jobs market in the US may be slowing down. So that, of course, feeds into interest rate expectations, with the US a 68% chance to cut interest rates again in December.
So if we do see interest rate cuts in the US, does that mean then the market will pick back up?
If we have a look at interest rate expectations, they do feed into future return expectations for the market, so they are extremely important. But I guess it's a bit of two sides of a coin. On one side of the coin, usually we get interest rate cuts because we see a slowdown in terms of the economy, which means a more difficult business environment for companies to operate in. On the flip side, in the short term, it's a bit of a sugar hit because companies do have to pay less in terms of interest repayments, so they do get a bit of a boost. So in the short term, you'd expect it to help the share market.
Well, locally, big bank earnings were out. We had Westpac, NAB and Macquarie at the end of the week. What was the theme?
If we have a look at the bank reports that we saw, Westpac, ANZ as well as NAB all came out with results, and three good things came out of that. First of all, FY25 earnings were relatively strong. Secondly, we saw lending growth still quite strong, especially in terms of business lending. And thirdly, the net interest margins remained relatively stable. But bank valuations are historically highs, and that means next battleground will be cost control. So watching that very carefully. And of course, today we saw Macquarie coming out with first half numbers. They disappointed, and we saw the stock tumbling down 6 to 7%. On the good side, we saw asset management, banking as well as financial services doing well, but we did see commodities really weighing on the result this time.
Julia Lee, thank you so much.
Thanks, Alicia.
A Melbourne Cup rate cut from the Reserve Bank was a non-starter this week, the board keeping rates on hold at 3.6%. And the RBA governor has signalled we may not see another one anytime soon. This report from David Chow.
At the race that stops the nation came the news that stopped punters in their tracks.
Very disappointing, especially everyone's got a mortgage.
I think the rate's already too high as it is.
We deserve another cut, and I think we've waited a long time to see interest rates come down.
But after a shock rise in inflation, the RBA governor wasn't taking any chances.
At the same time, the unemployment rate has gone up. It's still low relative to history, and monthly data are volatile, but the labour market does seem to have eased. So the board will remain cautious, driven by what the incoming data tell us about the outlook.
The RBA has kept the cash rate on hold at 3.6%, the lowest it's been in 2.5 years, after already cutting rates 3 times this year.
We are alert to the risk that we have misjudged the gap between demand and supply in the economy in either direction.
With power bills surging and property prices rising at their fastest pace in more than 2 years, the question now is, will there be some relief, and when? Markets are pricing in a 70% chance of another cut by May next year.
I think there is one more rate cut out there, though it may not be until the middle of 2026.
The next move is more likely to be down than up. When really depends on the data coming forwards.
While there's been no help on the interest rate front, the economy is looking a little bit sluggish. Unemployment's on the rise, household spending is virtually flatlining, property is becoming even more unaffordable, while economists say living standards are under pressure.
The squeeze is really on for families at the moment. You can see it, Australian productivity growth among the poorest in the world, and if the pie isn't getting much bigger, then there's not much room for us to share.
Leaving millions of borrowers feeling down on their luck.
With no more rate relief on the horizon, getting a foot on the property ladder continues to worsen for first home buyers. A strong spring auction season saw capital city home values climb at the fastest pace in 2 years. Now there's evidence rent vesting is on the rise. That's when first-time buyers break into the property market as investors. Nassim Kadem has the story.
At 1,010,000 across the road, the offer at 1,070,000 now, at 1,070,000 now, at 75 and 1,075,000.
Spring selling has seen a surge in auctions, and some first home buyers feel they're being priced out.
We've been to a few auctions now and there's so many people bidding and a lot of investors.
We're selling, and we're sold. Congratulations and well brought to you, folks.
National prices rose 1.1% in October and 6.1% over the year. The median home value is now almost $873,000. Perth led the monthly gains, followed by Brisbane, Darwin, Adelaide, the regions, Melbourne, Sydney, Canberra and Hobart.
We've actually created a system where it's more viable for some people to buy a home, not because they're going to live there, but to buy it to grow their wealth.
Come through, mate. Just shoes off.
At another open home in Melbourne, investors are on the hunt.
I'm looking to buy an older, rundown home, and I feel like pairing it with some good quality home renovations and with the Melbourne market prices driving up, I feel like there's some really big opportunities.
Lower interest rates and government incentives for first home buyers will continue driving people back into the market. With anticipation of at least one more interest rate cut, that could keep house prices elevated into 2026.
In 2026, we'll probably be getting to the end of that rate cutting cycle, and so potentially still price rises, but a softer pace than what we saw in 2025.
While these happy buyers have managed to get a foot on the property ladder, many others are still hunting for their dream home.
There's a renewed push to build up, not out, to help solve Australia's housing crisis. One prominent think tank, the Grattan Institute, says allowing three-storey dwellings on all residential land could slash house prices by $100,000 per home. But the construction industry says the biggest problem it's facing is a shortage of labour. Eliza Getzi reports.
On the outskirts of Australia's largest and most expensive city, builders are busy.
The interest rates have dropped. There's a bigger demand. More clients are starting to buy.
But builders and experts agree building out isn't enough to get Australia to the government's target of 1.2 million homes in the next 4 years. One solution from the Grattan Institute, building up.
The reality is Australian cities are some of the least dense of their size in the world. We haven't allowed enough housing in those areas where Australians most want to live, in those inner and middle ring suburbs of our capital cities.
The new report proposes a shake-up of planning across the nation by loosening regulations in all cities and suburbs. The Grattan Institute says it could add 67,000 new homes a year and save $100,000 a house by filling in the missing middle.
Townhouses and low-rise apartment buildings can help fill that gap, as can high-rise apartment buildings around key transport hubs and commercial centres.
The philosophy behind it, much like the housing ministers.
The more housing we build, the more affordable housing becomes for Australians.
She brought some encouraging news for the future of the housing supply this week.
Building approvals around Australia are up 15.3% on last year, Speaker. These are meaningful numbers, and this number has been growing fairly consistently now for 20 months. We have got a long way to go on housing, but we're seeing some really important progress.
But hitting the target might not be that simple. 176,000 homes were built in the first year of the National Housing Accord. But to reach the target by 2029, that number needs to hit more than 250,000 new homes each year for the remaining 4 years. That's hard to do when you don't have enough builders to do the job.
Skilled labour is still the number one issue that the building industry, not only in New South Wales but across Australia, needs to tackle.
Every day we're on the search for more trades to keep up with the demand of the framing.
It's a perennial problem that's adding to build times and costs.
More investment into the workforce, particularly into TAFE and training, but also for employers to take apprentices on.
There are now more people pulling out of construction apprenticeships than new starters.
We've probably been through over 30 apprentices since I've been working for the company that I work for, and I'm the only qualified employee.
But a previously untapped source of workers is growing: women.
In a sector where you essentially are only attracting 50% of the population, then inevitably you're going to have a skills shortage.
More women are joining the construction industry, not just on site, but in roles like management and design.
Paige Bainan is studying construction management and learning the ropes from her dad. He says land prices are another barrier to growing the housing supply.
Still, there's a cost barrier
The cost of the land, the cost of construction, a lot of them don't add up.
And with prices rising, time is critical.
The cost of holding that land, getting it ready for market, getting the infrastructure there, the duration, the time frame that it takes, that costs developers, that cost is inevitably going to be passed on to the consumer.
Red tape has long been a complaint from the industry, but governments appear to be starting to listen.
New South Wales and Victoria have unlocked the kind of high-density apartment buildings that we hope to see around transit hubs and other major commercial centres.
We are seeing some green shoots. Markets such as Sydney and Melbourne, which have been lagging behind.
Green shoots in the growing problem of Housing Australia.
Many households will soon have access to free electricity in the middle of the day to encourage more energy usage when solar power is at its highest. The Free Power initiative will be rolled out starting next year. But as Daniel Mercer reports, critics say the free solar could still come with a hidden cost.
As the days get warmer, like many Australians, Charlie Roderick knows her power use will start to soar, and so will her bills. And like 2.5 million other Australians in an apartment, she doesn't have the luxury of solar panels to shield the blow.
As a renter, obviously you can't just put solar on your roof, you can't really do much about it. You just kind of have to deal with the rising cost.
That equation could be about to change, with the federal government announcing it'll force energy retailers to offer free electricity to households for at least 3 hours a day. The scheme will be available to customers with a smart meter from next July, initially in southeast Queensland, New South Wales and South Australia. Households must opt into the scheme through the so-called default market offer.
There is no catch, but it's up to people whether they take this offer up. They could look at this. We are requiring energy companies to make this an option.
There is now so much rooftop solar in Australia that it's often squeezing out most other generators, including coal plants which are still required to help keep the grid stable. It's also pushing daytime power prices ever lower, so low, in fact, that generators effectively have to pay someone to take the output off their hands. Batteries can help soak up much of this excess rooftop solar, but they can be expensive. It's why the government is hoping this initiative will help shift more energy users to the middle of the day, when more energy is being generated. But not everyone is happy. Experts say the scheme will benefit households with a battery or an EV, but it could have unintended consequences.
But I think forcing retailers to offer it for free for 3 hours is only likely to push up other costs for consumers.
Apartment renter Charlie Roderick, for one, is welcoming the move.
Flicking my kettle on and looking next door at the solar and thinking, oh yeah, those panels next door are going to be powering this cup of tea.
Charging ahead in the solar age.
Another front has opened in the long-running climate wars, but this time it's the fight over dumping net zero within the coalition. Junior partner, the Nationals, have already axed the commitment, putting Susan Lee's leadership under pressure. They argue it's too expensive and coal, gas and nuclear should be powering the energy transition. But investor groups say dumping net zero will push up prices and put the coalition out of step with business. The CEO of the Clean Energy Investor Group, Richie Merzian, joined me. Richie Merzian, welcome to Close of Business.
Thanks for having me.
The coalition appears to be reigniting the climate wars. The peak business lobbies are backing net zero, and NAP CEO Andrew Irvin told the program business doesn't appreciate the whipsawing of settings. Do you think the party can take business with them this time?
The world's moved on from any debate on net zero, and it's been 10 years now since we've bedded down the Paris Agreement. To try and move away at this late stage will only undermine investor confidence. And it's worth remembering Australia remains highly reliant on global investment for its local transition. And so to build out the new energy that we need for the coal that will retire, we should be bedding down strong targets, bedding down policies and support, rather than questioning targets and moving away.
How hard will the clean energy transition be without bipartisan support for a net zero target?
It is noted that you have a partner in the alternative government that is now shifting away on what was a bipartisan approach to Australia's long-term economic transformation. And it will have some impact in terms of undermining investor confidence, The other impacts, though, will be increasing power prices as we put coal on life support and back in more expensive gas. It will undermine the potential for green exports. And we're seeing how crucial this is now with Rio looking for clean energy to plug into Tomago, looking for ways to continue to evolve in what will be a decarbonized world. So this is the time really for us to be all backing in net zero and for Australia to be making the most of the green export opportunities on our table.
Have you had a chance to talk to any of the coalition members about their positions?
The Clean Energy Investor Group talks to all parties, and we've put our views forward about how important it is that Australia has a strong target. That'll be a key indicator for global investors who can pick any economy to invest in when it comes to the clean energy transition. So we've flagged all these things with the coalition, and we're hoping that the coalition realizes that this is not just good for business, it's also a popular move as well.
Have you had any response from them yet?
Not recently, not since the Nationals have taken this position, but we'll continue to talk to them. We'll continue to put our views.
The Shadow Energy and Emissions Reductions Minister Dan Tehan says the scale-up of carbon capture and storage and nuclear are key solutions. Are you seeing investment in this?
Not when it comes to Australia's energy mix. Nuclear is not something that any international investor or local investor has talked to seriously, given that it'll be at least 20 years away. And we're looking at a huge transformation, a huge investment into clean energy over the next 5 to 10 years. When it comes to carbon capture and storage, it's not a solution that you can pair up with the power system. And it seems to be a solution that has always been on the horizon and has never delivered. And the problems we've seen with carbon capture and storage out in the West, in Chevron's project Gorgon, just show you how difficult it is to get CCS to work. I think there's clear-cut technologies that can deliver. That's solar, wind, hydro, batteries. Australia has the highest rate of big battery install per capita and has the third largest big battery install after the US and China. Those are the kind of solutions that investors are looking for.
Well, Dan Tehan is also claiming that coal, gas and nuclear are the cheapest forms of energy. He says the world will always choose the cheapest option. What unit for unit is the least expensive form of energy?
I think most Australians would know this answer because it exists on their rooftop. The cheapest power you can make is right there with rooftop solar, followed by utility scale renewables. We know this. The Gen Cost report by the CSIRO and the Australian Energy Market Operator shows this over and over again. There have been some increases in the capex for wind deployment, which is part of a global shift. But when it comes to solar and batteries, the prices continue to get cheaper and cheaper. So we know what the solutions are. We know what the tech is. We have a energy net zero sector plan that the government has just released. And I think investors are looking at that now as a blueprint for what to invest in.
The Nationals leader David Littleproud this week said Australia's bid to host the COP Climate Summit is a $1 billion vanity project. What's your view?
The UN climate conferences are the main way for the world to get together and agree on what is the next raft of proposals, what is the next wave of implementation that we need to address this global problem. This is also the world's largest trade show for clean energy solutions. Over 70% of the investment for Australia's clean energy comes from overseas. And if we have the opportunity to have the whole world on our doorstep, checkbook in hand, ready to invest in our net zero transition, that will lower the cost of capital, that'll lower the energy prices we ultimately enjoy, and that will ensure that we have new green exports to replace the coal and gas that the rest of the world will stop purchasing because the rest of the world is also moving to net zero.
Richie Merzian, thank you so much.
Thank you.
The corporate regulator says Australia's booming $200 billion private credit sector needs to lift its game. ASIC's latest warning comes after its year-long investigation uncovered problems including opaque fees and potential conflicts of interests. The chair, Joe Longo, told the National Press Club there are growing risks in the system.
We've already seen missteps and failures in the private credit industry as a result of the wide variance in practices across the sector. We've seen high-profile collapses in the United States with First Brands and Tricolor, and warnings of cockroaches and contagion. And the Bank of England Governor, Andrew Bailey, has said the whole situation reminds him of how the global financial crisis started. If we fail to address the risks building in this sector, we could very well see our own Minsky moment in Australia with a market collapse.
I spoke to Chief Business Correspondent Ian Verinder earlier in the week. What did ASIC find in its report that has the chair worried about a potential crash?
Mostly, Alicia, gets down to transparency and disclosure and the lack thereof. And the other thing too is, I mean, $200 billion as lending out there, this has gone completely under the radar. It's without any of the requirements that a regulated bank would have to adhere to. And it's a 500% growth over 10 years. So the amount of money pouring into this is growing at an incredibly rapid clip. If you look at America, which is really the epicenter of private credit, $3 trillion worth of loans out there.
Well, Joe Longo cited building risks overseas. What are the risks that we could see those play out in Australia?
Well, I mean, we've already seen a couple of collapses. There's a pub owner, John DeGemis, who was a former investment banker. Now, he built a whole portfolio of hotels. I think he bought around about 22 hotels, started to renovate some of them, didn't really do much with any of the others. Now, the whole portfolio of hotels, I've gone through the list, cost around about $300 million. He's got $1.8 billion worth of debt, and it's the whole, edifice has collapsed, and everyone is now after their money. So that's the only really big example we have at the moment. But I mean, ASIC did uncover some other problems there. It actually issued a stop order against one big player, Latrobe, and Latrobe was actually a big lender to John DeGemis.
Well, Joe Longo and ASIC are threatening to bring the private credit sector into line. How big a stick can ASIC wield here?
Well, I think it really needs the help of the government. I mean, Joe Longo has mentioned the word law reform, and because this is a new area and it's grown up, around the banking system and underneath the banking system, there needs to be, I guess, probably new legislation put in place to allow it to regulate those markets.
Ian Verinder, thank you.
Thanks, Alicia.
And that's all from Close of Business. For more on those stories, you can go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern Daylight Time on the ABC News Channel and after the late news on ABC TV. I'm Alicia Barry. Thanks for watching.